Hi friends, so I'm recording this in the midst of rather dramatic occurrences happening in American banking industry at the moment. We've had the Silicon Valley Bank collapse, so there's been a whole heap of chatter on social media about what caused it, what the effects are and what the ramifications might be. There's been some rather strange conclusions made by some people. So the idea of this and the blog article that is linked down below is to just put forward the facts about what we know so far occurred, the response, and in general what kind of outcomes we could see. So what I'll do is I will bring up the blog post that I'll link below and you can go through and read yourself. So it's about the collapse of SVB, Silicon Valley Bank. Everything you need to know without the noise. So at the top there's a TLDR which we'll go through, and then below that is the full article that you're welcome to read. So what happened was the Silicon Valley Bank had to report that they lost 1.8 billion or almost 3 billion Australian dollars in losses on its sale of US Treasury bonds and securities. So this prompted investors to pull the money out, leading to the regulators shutting down the bank last Sunday on the weekend. This is the biggest bank failure since the 2008 global financial crisis, and the second biggest this century. So there's about $200 billion in assets that Silicon Valley Bank held, and 65,000 startup companies receiving venture capital were customers of SVB. So the flow-on effects go all the way through the tech industry. And so on the weekend, the Treasury, the Reserve Bank, and the Federal Deposit Insurance people came together and safeguarded depositors. So previously any depositor up to 250,000 was protected, but the American government and the Reserve Bank, or the Federal Reserve, have increased that to cover any depositors in the bank regardless of the size of their deposits. And so there's two other banks that went down as well, Silvergate and Signature Bank. And so in the wake of all of these together, the various analysts worried that it could trigger a wider US recession, which could in turn spread to the rest of the OECD countries and create a worldwide recession. Now, how it all came about is rather interesting. In 2008, all the banking and financial systems troubles came about because of risky assets that people didn't really understand. Whereas this time, the asset that caused the SVB collapse was actually government bonds, which usually you think are safe and secure and non-risky, and kind of ironically they've brought down the bank. And so how that happened is the price of bonds matches with the face value of the bonds to create a floating return on that bond. So I'll use figures here that are just nice and simple so that I can give an example. So let's say it is a $100,000 bond and it's paying 10% at face value. And so if you buy the $100,000 bond at 10%, then you're going to receive $10,000 per year on that bond. Now, there's a secondary market for bonds, the bond market, and they then get passed off at a price either higher or lower than the face value of the bond. Now, if, say for example, the face value of the bond increased, and so now the face value of the bond was, again an extreme example, $200,000, you still are getting the return of 10% on the face value of $100,000, so $10,000. But now, instead of the return on the bond being 10%, it's now 5% because it's worth twice as much, but you're still getting the same return of 10,000. Now, the opposite could happen, where if the value of the bond goes from 100,000 down to 50,000, you're still going to collect $10,000 because it's 10% of the face value of the bond. And so in this case, the return would be 20%, i.e. $10,000 compared to the $50,000 that the bond cost. And so as the bond prices move, their percentage return moves as well. Now, this percentage return that moves is important because it matches the interest rate. And so the bond market effectively sets the interest rate, because what the government needs to pay for interest, everybody needs to pay for interest. So the interest rates and the bond yields increase, and that was shown in our example by the price falling, because remember, it was 10% at the start at 100,000, and then as bond yields increased in our extreme example to 20%, the price dropped. And so that's what happened to SVB. They had bought bonds, but then the price of the bonds dropped. Their income from those bonds still remained the same, but their paper value was worth less because the price dropped. Their returns were the same to change the percentage returns on the bonds to match the interest rate that is in the market. Now, why did they have all these bonds? Well, the Silicon Valley Bank basically got in more deposits than they knew what to do with. So they had the deposits from all these startups, and then their lending wasn't enough to lend out all the deposits that they were getting in. So with that extra money that they had left over, they bought government bonds, which you would think was a sensible idea, except for some reason which will probably come out in the wash, they never actually considered what would happen if those bond prices fell so that their yield could rise in line with interest rates. So then, Silicon Valley Bank is made up of startups. Startups need money. So the startups are coming to SVB Bank and saying, can you give us some of your money, or our money? And then SVB ran out of at-call money to give them, because banks only hold sort of 5 or 10% of the amount of deposits in the bank in cash. And so once they couldn't satisfy the deposit demands with money on call, they had to start selling these US securities. Now, when you sell anything and you need to sell it quickly, you have to sell it at whatever price the market takes you at. And remember, in our example earlier, we bought at 100,000 and then the yield increased, but the price dropped to 50,000. Now, of course, that's an extreme example, but the same thing happened with SVB Bank. They bought it at a price of 100 basis, so the 100% of their original price, and then that price might have dropped down to 90% of the original price, but they had so much of these bonds and so many depositors calling in their money that they then needed to sell those bonds, and each time they sold them, they were losing that difference between the price they paid and the current price to correct the yield to the interest rate. And so what began as a liquidity problem, where they didn't have the money to pay the depositors the money that they were asking for out of the bank, turned into a solvency problem because they were losing money selling these assets. So they had to write down these assets on their books. And so that's this point here. The cause of SVC currency collapse was due to the bank's investment in treasury bonds, which saw its value decrease as the US Federal Reserve raised rates. leading to substantial losses for the banks. And so what the regulators did on the weekend was they could see that the Silicon Valley Bank had basically taken losses on their treasury securities to bring the value of their bank down to zero, perhaps negative, maybe still slightly positive. No one exactly knows. But the regulators came in and said, okay, we're going to stop the sale of these bonds at a loss, and we're going to step in and guarantee the depositors' funds so that if anyone wants their money, we can pay them. And so that stopped the liquidity crisis becoming more and more of an equity crisis. Now, there's two things that immediately happen to that. There's pressure on the tech startups that had their money there, because this is going to take a little while to grind through. So everybody who has money in that bank will need to wait to access those funds while the government sorts out this rescue package. And of course they won't be able to pay their bills, their wages, etc. in that particular period of time until their money becomes available again, which due to the money multiplier then travels down the line, because if they're not paying employees can't pay rent, people aren't receiving rent on their investment houses, therefore can't pay their mortgage, and it spreads out through the whole system. And so that's one risk of the contagion causing a recession as it spreads out across from the financial sector into the real economy. And the second one is if SVB Bank has suffered this problem where they have an overexposure to US Treasury securities which have fallen in price, and therefore leading them to their asset sheet to become worth less and perhaps even to be insolvent. Has this happened in other banks in the banking sector? And of course analysts are going to be poring over all the different banks this week looking for other similar banks that have similar kinds of problems. So are we at the beginning of this crisis where we then see a whole heap of other banks holding large-scale treasury government bonds, not just in the US but in Britain, Europe, Australia, even other places throughout Asia? Will we see more banks having pressure put on their solvency due to this loss of paper value of securities so that they can match the bond yield? Or is it just a one-off or affecting only a small amount of banks? Now, one thing that it will do will be give the Federal Reserve pause to think, because they were widely expected to continue to raise interest rates in the short term, but with this shock coming through the system, it could be doubtful that even if there is high inflation numbers, the Federal Reserve right at this point might pause their interest rate rises to prevent more pressure coming on banks that hold too much treasury securities. And in the long term, the question really needs to be asked, how come these banks were so heavily laden in one security which exposed them to such a risk of interest rates rising? It's not as if interest rates weren't at an all-time historical low, and almost the only way these interest rates could have gone were up. But it seems like the Silicon Valley Bank, just did not really consider what the ramifications would be should the interest rates rise sharply, as we've seen, and if they couldn't pay the deposits on cash at hand and were required to sell their treasury assets at a loss, leading like I said earlier, from a liquidity crisis into a solvency crisis. So hopefully that explains just what happened with the SVB bank collapse and why it happened, and what we might see in the next little while with regards to other banks having a similar problem, and the Central Reserve of the Federal Reserve of the American banking system deciding on which way to go with interest rates at their next meeting. So hopefully that clears it up, gives you a full rounded picture of what happened, the cause of it, and the potential problems that other banks might see the same situation occur to them. So I'll put the link to our full blog right up down below, but hopefully that sheds some clarity on the subject. And thank you for watching, and I look forward to talking to you again next time on the channel. So if you like this roundup, click and subscribe, and we will be uploading more commentary about the market, more help about SQX, the algorithmic trading creation program, and MT4, the most used trading program for Forex in the world. So until then, stay safe financially. Bye.